All right, guys, on May 11th, we're going to do a masterclass all about buying businesses. We're going to go through acquisition from start to finish, everything you need to know every step of the way. We're going to have a bunch of people in the room that are doing the same thing. And really, you just got to get around the people that are doing what you want to do. So join us on May 11th. The location is to be determined. However, if you join the Entrepreneur Fellowship on Facebook, we'll post all the details.
All right, welcome everybody. Another episode of the Entrepreneur Fellowship podcast. We got Andrew West here, Jake Fafaro, and Cal Boyden. And of course, myself, Isaac Schaefer.
Nice.
Excited to be here, guys.
Yo, me too. I like this new spot.
Yeah,
it's awesome.
Yeah,
check out our new digs.
New recording
Shout
studio.
out to Brianna Holmes.
So guys, today we are going to be talking about something that we've talked about a lot on this podcast, but we're going to really break it down. We're going to be talking about the differences, the advantages and disadvantages between real estate investing versus investing in businesses. This is a really common thing that comes up in our podcasts, and today we're just going to really break it down. Andrew and I are going to be naturally, but also on purpose, kind of playing the devil's advocate. We're going to be making the case for real estate, and Jake and Kyle are going to be making the case for small business, and we're going to see where it goes.
Let's battle.
Let's go, guys.
Let's battle.
Do it.
Well, Jake, Kyle, who wants to start things off, man?
You know, doesn't even matter.
Why don't I get it rolling with just kind of what passive income is as a whole? Maybe each of us can kind of give our perception of it. But to me, passive income is almost a bit of a tall tale, right? But to make passive income is, I would expect passive results, right? I don't have a whole lot of control over something I'm not putting time into. And so for me, I would think of a passive income as maybe the stock market, but I have very, very, very little control over that. And I've heard people counter that with, well, you can control it and you can do these different options and buys and all these different plays to do it. But then at that point, it's not passive either. Now
Right.
you're basically playing a day trader and you're studying a ton. And so now it loses the passivity of the investment.
And there's a lot that goes into that. Like,
What do you mean?
as far as the stock market and trading, whether you're, swing trading, day trading, I mean, you're having to go really deep on the companies, what they're doing. Hopefully, you have some information on what the company might be doing. I don't know. It's a tough world. So that is far from passive income as far as I'm concerned.
And I think COVID proved that even regardless of the strength of the company, it doesn't really matter what the stock's going to do, right?
Yeah, man, if you're in
controlled by
plexiglass
public
companies
opinion.
during COVID, you were crushing.
And what about GameStop? It's about to go bankrupt, and it just takes off on one of those roller coaster rides where all these armchair investors get rich. It's not based off the fundamentals of a company anymore.
Yeah, absolutely.
Yeah, I don't think like day trading and stuff that you're really doing in the market is, we would consider that passive, obviously. But like just setting your money in, say, Apple or Amazon or something where you're going to get, hopefully, a guaranteed 4 to 10% over the next decade or 2 decades. I think that's kind of what people, think about as far as like passive stock market investing. But then let's talk about passive investing in real estate.
Because I think you hear that all the time, right?
Yeah, I think Robert Kiyosaki with that, like truly, because buy single family rentals, collect your rent, pay your mortgage with your rent, and you have some left over, and that's cash flow, right? So it's like, well, that's all fine and dandy until it doesn't work.
Till water heater blows through the roof.
Or, yeah, exactly, go up where it's impossible to actually do.
Or you have to evict a tenant, or countless other examples.
Exactly. And I definitely don't want this podcast to shy people away from investing in real estate, because I think it's an amazing asset class to invest in. However, I think it's depending on your situation and what your goals are. If it's for cash flow, I'm strongly against investing in real estate. Cash flow just doesn't make sense.
Yeah, and I think that in the very beginning, when we were talking about the Entrepreneur Fellowship, what we wanted it to be, what we wanted it to look like, the very clear path was like, this is what's working right now. In 10 years, it might change. And we want to build something and a group of people who are willing to pivot and willing to be able to really analyze and look into what's going on in the future. So right now, if you were getting into, I think that if we were having this conversation in 2012, 2013, 2014, everyone would have a completely different tune. But the fact is, it's 2024. Interest rates are crazy. Things aren't moving the way that they were even 2 or 3 years ago.
Valuations haven't come down.
Yeah,
for
exactly.
a home.
Yep. The question I keep asking myself is, does that cash flow make sense? And when I was looking at still getting into real estate deals and I'm seeing these 4 caps, it's like, well, there's T-bills and different other places I can park my money and get a guaranteed 5% interest rate.
Yeah.
Right.
And to me, that made more sense. There's no minimum deposit I need to put into it, and there's no pipes and electrical that could go astray when my money's in a bank account.
Toilets and tenants, or whatever that saying is. Yeah. I also think like when interest rates start to come back down, that makes buying a small business even more attractive, because that SBA interest rate comes down as well, right? So instead of paying 10%, which is kind of the going rate, give or take a percentage, I was looking at SBA interest rates back in 2020 and 2021, and it was like 2.8. I'm like, oh my
Get out of here.
Yeah. Like, that's nuts.
Dude, that is crazy.
Yeah. It makes such a bigger difference because it's on a 10-year note, you know?
Yeah, absolutely.
So, I mean, the point is, real estate is not passive, but as we said, we're going to play devil's advocate. Obviously, neither is business ownership. If you buy a business, you're not buying, most likely, you are not buying something that you close and then you're like, cool, the paycheck's coming in and I don't have to do anything. You have to do.
Man, wouldn't that be nice?
Wouldn't that be nice? Yeah, I know. If somebody, hey, by the way, if someone has an investment like that, let us know. We're all ready to change this podcast. But this is the best we've found so far. So, like, let's juxtapose the two. Like, which one would you say is more passive? Because I would argue that, yes, real estate is not passive investing, but I mean, I would say I'm definitely more passive with my fourplex than you guys are with Rainier Cleaning Solutions.
I would agree with you for the most part.
You make more money
because the fourplex is also an Airbnb, right? There's a lot more that goes into it than a single family rental. So I don't think that's passive, or should be considered passive, like, whatsoever. It's definitely like income. We've all said it, like, it's on a spectrum, and I think that for business ownership or buying a business and buying real estate, there are more passive ways to go, just like there are more active ways to go. So if you're going to be an owner operator, yeah, you're going to be a lot more busy, but you're going to make 100 times more money, right? And then you can also buy something a lot bigger that has a management level in place, so you're not answering the phones and you're not as active as you would be if you were, say, a general manager.
Well, and that's where the similarities are really prevalent, because, I could counter that by saying, well, yeah, I could also buy an apartment, right? Get a property manager. The margins are a little better on an apartment, and everything's, a lot easier, a lot more passive or less active. But the problem with both buying a bigger business that already has operators and so on, and the problem with buying an apartment is you need more money down, right? You need it, you are, it's harder to qualify for those.
Harder to find, all those way
things.
more saturated.
So in that way, it's very similar, right? If you buy a single family home and you don't have the margins to get a property manager, that's going to be a much more active investment. That's the same if you buy a small business. So in that way, these are very similar investment opportunities.
Except for compare a larger apartment complex and a mid-size business, say, that's revenues doing in between $2 and $5 million. I think it's a lot easier to find that business to buy than it is to find that apartment building to buy.
That's where I'd agree with you.
So I don't think the opportunity is similar.
And when comparing the best investment vehicles, there's a whole bunch of different metrics we can compare it to, right? If we're just looking at passivity, real estate's probably going to be a more passive investment at the end of the day.
Oh, yeah.
But if we're looking for a cash-on-cash return, cash flow, a number of different things, I guess just speaking for cash flow, what we have found is that business is what makes the most sense for us.
And I think it's important to keep in mind you and your situation, right? Like, are you trying to escape a W-2 job that you hate? Are you trying to retire your wife? Are you trying to, depending on your situation, I think if your situation is similar to a majority of people, is like you're trying to get out of a job, like the job you don't like, then I think buying a business 10 out of 10 times makes more sense than investing in real estate.
Yeah, I think that's really important. Spoiler alert, at the end of this podcast, you are not going to have an answer, right?
Yeah. Oh, man.
There is, and thus, here it is. You should only buy this. Like, that's not going to be the result of this podcast. The result of this podcast is probably going to make you more confused, but hopefully we can, or more confused about what you're going to do, but hopefully less confused about why certain options are better than others, depending on your situation.
So what if you're 60, 65 years old, you have a healthy either 401k or some sort of investment account, and you're thinking, I want to go place a bunch of that in real estate. Could you think, I want to go buy a business and just put an operator in there and make way more money? Because I mean, I think that's where the rubber meets the road with all of this, is that in real estate, you're going to make a whole lot less money. It might be more passive, but the amount of money you're going to make is so much lower. Is that possible? One, and two, would you suggest it?
It's going to come back to the self-awareness again. If I'm 65 and my 401k has a whole bunch of money in it, and if I'm looking at that and I've met with my financial advisor and I could just live off of what I've already done, I'm probably not going to take a whole lot of risks at that point. I've already done enough risk taking in my lifetime, and I'm ready for easy street. This is going to be how a lot of people are wired at that point. If I need to, it's quote unquote healthy, but if I live to be 82 years old, I'm going to outlive my funds, then I need to do something a little bit more aggressive. And at that age, I think the average person would want something with some passivity to it. So whether it be buying an apartment building or a business where you're not hands-on day to day, it would come down to what your skill sets are, what you want, what your risk tolerance is.
Yeah. Don't you think that buying, like, say a large apartment building, and then also in the same breath buying a business that is doing, $10 million a year top line, you're going to end up making a whole lot more money in 5 years than you would in a real estate building?
Yeah, I mean, your cash on cash return is going to be, there's no comparison at all to what you're going to get from buying a business.
And when you get to that level of business, do you think that those are going to be a lot easier to? So I guess what I'm trying to kind of steer you to is, like, if you're looking to buy a business that does, $1 or $2 million a year, that's going to be a lot more hands-on. If you buy a business that's doing 10, there's already going to be a management structure involved. There's already going to be a GM. There's already going to be maybe a clear number 2 that you could go put that money in, and maybe you're doing 10 hours a week.
Yeah.
Right.
No, that's a really good point. And I also think we have to talk about this whole idea of buying a business and just putting an operator in place, because I don't think that, yes, it can definitely work, but I think it's one of those more like a clickbait line that in theory it sounds good, but I don't think in practical real life it works like everybody assumes.
Yeah, I think it's a bit of a flawed strategy of, I'm just going to buy a company that's quote unquote big enough or quote unquote good enough, and then I'm just going to sit back and pray. That's not really a good investment strategy. If something goes wrong, do you have the kahunas to grab the steering wheel and get the ship right back on path? Mm-hmm. Do you have the skill set? Do you have the grit to be able to do that? And if not, it's not a good investment, because I think things go wrong, right?
Yeah. And I think buying a business that already has an operator in place, that's a whole different story, right? That's been with the company for 5 years, 10 years. It likes their positions, good at it, a general manager, et cetera. That's a whole different story than placing somebody that you hire into the position, into a brand new company when you just transitioned, and all these employees are now having to get used to this person and you, and the job probably isn't exactly what you made it out to be. So I think that we just have to keep that in mind. It's not just like a plug and play and you're going to run a weekly meeting and collect a $40,000 paycheck every month.
I think we would all agree at this table that cash flow is better with businesses versus real estate. I think if you disagree with that, no offense, but you're
not listening.
Yeah, you just haven't looked into it. I would say cash flow goes to business. So I'm going to do a little check mark there. What about learning curve? I would say my argument would be the amount of education you need to get into real estate investing. We've already established that cash flow is better. It is much less. You can house hack, for example, buy a duplex, live on one side, learn how to be a decent landlord to the other side. You could do that much easier. I'm not saying, like, I'm not making blanket statements, but I'm saying it would be easier than just about any other business you would buy. Would you agree with that?
Yes.
100%.
Okay, we're going to give that point to real estate there. Let's go passive versus active here.
Okay.
I would say real estate is less active, more passive. It is not it's not passive investing. We've already established that.
But more passive.
But it is more passive than most businesses you would buy. And then if you were to scale that and you'd say, well, you could buy some big businesses that are more passive. Well, similarly, you could buy some big real estate and have margins for a property manager, which would also be more passive. So I'd say dollar for dollar, it is more passive to buy real estate. Would you agree with that?
Yeah, just with the exceptions of running short-term. I think that would be the only.
I would completely agree with that. Absolutely.
That would be the only asset class I can think of that would compared to how active you have to be in a business. But
yep. I think something we're seeing now, especially with interest rates going up, is people having to get a little bit more creative with their properties, right? To get that cash flow they want. And at some point with that same amount of energy actually be better spent on a different asset class. But
yeah. Okay.
Yes, as a whole, that's a real estate check mark.
Okay,
It is
got
more
it.
passive.
What about tax advantages? Should we call Brianna in?
On the line here.
yeah, no, I think that in my opinion, it's pretty even with the exception of like cost segs.
Yeah.
I think
I'd agree with that.
Like the short-term rental loophole or a multifamily or mobile home park cost segregation definitely would go to real estate. But I don't think that's a majority of our audience.
But what about
in
depreciation? Depreciation is a huge tax advantage with real estate that you don't get with businesses.
You do.
Yeah.
Depreciate though the assets in the business. Oh wow,
Yeah.
Am I looking really ignorant? Is there?
No.
No, you're not looking ignorant, but you can't. Absolutely, yeah.
But just the assets, and the assets are your trucks and your cleaning supplies and so on. It's not your depreciation is going to be significantly less with businesses versus real estate. If I'm wrong, obviously call me out.
What are you depreciating in real estate? The asset?
The building.
Yeah.
Yeah, so
but I
it's
mean,
the
when you look
it's the
at
same rules.
when you look at your assessed value, though, your land's worth $150,000, your structure's worth $500,000, so you're depreciating significantly more.
Yeah, I would say yes in general, but you have to consider like a lot of businesses have real estate attached to them, right? So if you're just talking about a business that has zero real estate attached to it, in general, yes, but there's a lot of assets in a business that you can depreciate, right? Think of like waste management. Like their depreciation on that company is going to be way more than a huge apartment portfolio.
Right.
Because think of running 500 trucks that cost $100,000 each. Like that's a lot of depreciation.
And just think
That's
of
a
how
lot of
much
depreciation.
how is done on these small businesses as well.
Yeah,
How
I
these
didn't
small
want to say
businesses,
that.
how they fund a lot of people's lifestyle.
Well, I can say it because I don't have a small business, so if the IRS is listening, like I'm not actually doing this. But I will say, I will say, if you excluding, if you have a short-term rental, if you have a rental property and you want to write off the couch that you're buying, you can't just do that. Whereas you can do that with a business. Again, you can't, but I'm not doing it.
But you can't write off a couch?
No, you can with short-term rental. With a long-term rental, you can't because you're not furnishing the apartment, but you can be furnishing your office and, writing off that business expense, right? Yeah. So that you have more potential opportunities for those write-offs with a business. So I would agree that with tax advantages, it's probably a neutral. There are some advantages and disadvantages.
Probably comes down to how aggressive your CPA is as to which one's going to be better for you.
Totally. So I'm cool calling that a neutral.
And we know you like to walk the gray area with the taxes.
I don't know what you're talking about. Okay, let's talk about appreciation. But before we talk about it, I'm not talking about forced appreciation. That is another line item that I want to talk about because forced appreciation is a different factor. Real estate, I would argue, and again, I'm playing devil's advocate, so I'm allowed to do this. I would argue that real estate naturally appreciates better than businesses do, considering zero forced appreciation. You buy a home, you do nothing to it, it's going to appreciate better than if you just buy a business and you do nothing to it. You just keep running it the way it is.
Ooh, I struggle with that one just because you're in a bubble here.
Totally.
In Washington, Oregon, California, anything on the coast, I would 100% agree with you. But a lot of that real estate in between the coasts, that doesn't appreciate nearly as much as. So, and I think that business does appreciate because prices do go up, right? You do 5% increases. You do that fuel surcharge increase to really try to match inflation. But generally speaking, I think real estate would get the check mark for that one because I'm in a bubble as well, right? And I have to kind of take that into consideration. What do you think?
Yeah, I would give it net neutral at best because with business is inherently, even if you're not selling, theoretically, if it's being ran properly, it should be growing just a little bit. Like I get what you're saying about the forced appreciation, but the nature of the businesses, they're built to grow. While the real estate's appreciating, like it's also depreciating as far as like the cost of ownership, the cost of holding on to it, right?
Yeah, absolutely.
The walls need to get painted, the cement's starting to crack underneath it, the foundation. There's all these little different things. Rats are chewing through the siding. There's all these different things that are happening that are an expense.
Yeah. What do you so let's take Tacoma, single family house. what's a going price? Not the north end, not the east side, just something more average. What's the cost of that right now?
475.
Yeah, I think average median is like just under 5 right now.
Okay, so where we're at today in 2024 with what's going on in the market and everything, how much do you think that house will be worth in 10 years from now? I think it's probably going to be worth 650, 7, maybe 800,000.
Yeah, I mean that would be an impossible question. I mean,
No,
if we were to go
personal
14, though,
opinion.
I mean, if we were to go back to 2014 versus 2024,
About doubled, right?
it's doubled.
Okay, so about doubled,
Yeah.
right? So about 800,000. So if I bought a company today that was worth 475,000, naturally growing, just kind of not aggressively, but just natural growth, I think that company in a decade would be worth 800,000.
Okay. All right. I'll give you guys the neutral on that one. I know you're going to win the next one, but I'll give you the neutral on that one.
No, you want to say something?
No, I mean, I think that is, I think that goes to small business, not real estate. If I'm being completely honest, I don't see how, let's just talk about contracting, right? So in 2019, right before COVID, we could go put in a kitchen for, and granted, it's like a base kitchen for 30 grand. That is now 60 grand in 5 years. So the top line is going to grow.
Yeah, your cost is higher. I totally disagree with that. Your cost is much higher. That's part of the reason why it's gone. Like the cost to consumer is higher, partly because wages have gone up, but also because the cost of material is higher, and also wages have gone up, meaning the contractor also has to pay his people more.
But if you're going to play that role, the cost of real estate's
Yeah, and your
course.
dollar per hour has gone up.
But interest rates go up and down, and that
Well, not
affects
like-
business
not like
buying
they
too.
have,
But
though. Like,
that affects
that's-
business buying too.
No, it does. But what it's if we're just talking about the costs, I think that back then, so 2020, let's say your mortgage would be $1,800, or now it might be $3,200 or $3,500. The cost to maintain that asset is 2 times, right? So I just don't see how, unless you're buying in the north end and you're doing a bunch of force appreciation, how it would keep up with business.
Well, okay. The reason, if I were to summarize why I think appreciation would go to real estate, but I'm fine relenting, calling it neutral. I'm not going to relent and give it to business. The reason is because real estate is a limited asset. Businesses are not.
You don't think so?
No, I mean, anyone can go start
Established businesses?
No, yes, but anyone can go start a business and make it established in the next 10 years. So you could buy a business tomorrow that will be oversaturated in 10 years.
Stats would say otherwise. Stats would say 90% aren't going to make it past 5 years.
That's
50%
true.
aren't going to make it past 2 years. If we were comparing it to starting a business, yeah. When comparing it to buying businesses, I think we're being generous giving you a tie on it.
Yeah.
And what's making me weird about this is the trying to leave the forced appreciation out of it.
I probably should have blended them
trying to
because
put
you're definitely going to win the forced
a
appreciation
line in the
one.
sand there.
But my thing about real estate that is, I just can't get over about real estate is the fact that they're not making more land, right? There is only so much land, right? And so when you buy real estate, that is real. There cannot be taken away from you. I know, but of course, I suppose I am absolutely in my bubble.
Drive across the country, you'll see there's plenty of land.
Yeah, no, that's a good point. Yeah, I am definitely in a bubble here, but that's the bubble I'm in, so I'm going to keep talking to that bubble. But but anyways, I am good relenting that as a neutral, but I would say real estate is, well, the problem is I have another one here as safety, secure, which is a safer investment, and that we'll get to that later. Ooh, so maybe that is also kind of blending it with that. But I see both sides, so I'm good calling it a neutral. Okay, let's talk about forced appreciation.
This should be a quick conversation.
Yeah, it should.
Yeah, I think it goes to business hands down.
I completely agree.
The real estate appreciation, you only have so much control over, right? You can only build a new kitchen so many times, a pool so many times. There's only so much you can put into it to actually add value.
Completely agree.
Versus a business, every extra dollar of revenue I bring into mine is now worth $4 to the value of the overall company at this point.
Yeah, and how you can buy something at a 2x and automatically be worth a 5x when you buy it, that's without any forced appreciation.
Do you want to explain on that a little bit?
Yeah, I'll let CFO do.
So we have a number of different ways to control the value of our company, and it's going to be, at the end of the day, our company is going to be worth a multiple of our net income, whatever the company is making, right? And so when we go to sell it, we'll multiply the net income times X, whatever the market value see that at. Right now, our company is worth somewhere between a 4 and a 5X when we exit. Right now, Jake and I are fishing for companies that are smaller than ours, that don't have the infrastructure in place, and we're kind of literally just looking to buy books of business and maybe a small handful of good employees with that acquisition. And by hunting for that size of fish, by fishing for that size of fish, we're getting companies and we're paying 1 or 2X a year's worth of profits. So as soon as we buy them and then roll them into our holding company, each one of those dollars is immediately worth 4 times instead of 1 or 2 times.
And you cannot do that with real estate. I mean, you can say, well, I could, keep adding to my real estate portfolio and sell the whole bundle.
The leverage you're getting in real estate just isn't going to be quite the same at the end of the day.
Absolutely. And another thing I'll say for forced appreciation for business versus real estate is for all those people who invest in commercial, they're like, commercial's the same way. If you decrease spending and increase income, you're going to increase the value, because that's how commercial real estate is valued. The difference is, and I'm curious to hear all your thought, but the difference is the amount of expenses that you're able to decrease and the amount of income that you're able to increase is much smaller.
It's capped.
Yeah, that's well said.
Rent can only go up a certain amount. You can make the bathrooms as nice as possible and the kitchens as nice as possible. You can't change the location. The location is only ever going to rent for the top dollar for that location. And your expenses, you can't cut utilities.
You only have so many you can control, right?
Exactly. Yeah. So you are capped, and that's why forced appreciation absolutely is a thing in real estate that is very important, and everyone should know about it. But you cannot do as much as you can in business. In business, you can add a whole different field. You can have a cleaning company and add a window cleaning. Boom. You can't do that. You can't have I guess you could have an apartment and add a pool, but even that isn't going to increase it by $1,000 a month per unit. It might increase it by $150 a month per unit. I'm obviously talking out my ass. I don't know for sure, but you get my point. You are capped at a certain point.
Yeah. And compare what Kyle was talking about, how you buy it at, let's say a 1 or 2X, and then it automatically becomes a 4 or 5. With real estate, it's not like you can go buy another building and make it a part of that complex. Right. So it's just the cheat code.
Absolutely. Think about
can't go buy a Class C property and bolt it onto your Class A property and be like, no, cap rates are 3.5.
Relocate this building. Yeah. And think about when COVID hit, all of a sudden all these big buildings are just vacant with no other option. Yeah. And these businesses that now aren't in them are now pivoting and selling gloves, face masks, hand wash, sanitizer, whatever it is that they pivoted. But a lot of businesses just went a completely different direction.
Well, and that actually is a really good transition. If you guys are done with that one.
Check mark, let's move on.
Yeah, no, I did. I gave it before I even asked. A really good transition to my next one. I kind of had 2, but they're actually the same thing. I don't know why I wrote them down as 2, but which one's more secure, which one's more risky. And that would be a good point to yours. If this is a bad example in our bubble here in Pierce County, but if JBLM left, which is not unheard of, by the way, for an Army base to just go. We found cheaper real estate and move. It's not going to happen with JBLM almost surely. I think they're the 6th biggest Army base in the United States. But pick the city. There are big job markets, big industries in those cities. And if one of them leave, that dramatically affects the value of your property. Whereas with business, well, actually, I'll let you guys finish.
I think it affects business as well, right? Because
I guess
there's a lot less
consumers
to buy the products or services you're offering. So in that aspect, I would say probably fairly neutral.
Fair.
I think they're 2 of the safest investments you could make. I would now throw in crypto or stocks or other stuff if I was looking for a higher risk, but real estate, as far as a long-term buy and hold wealth generating tool, it's about as good as it gets, right?
I think business is much more risky.
I would say so. So to de-risk our purchases, Jake and I are looking to buy companies that have been in business for a very long time. They have a really long track record, employees that have been there for a long time. There's 10 or so different things that we're looking for to make that acquisition less risky. Just inherently, you got to do a little bit of research still, but it's a pretty safe play.
It's like an inspection for real estate. That's kind of roughly. Maybe a sewer scope if you live in Tacoma. And then, but with business, you're thinking probably 20 to 30 times more due diligence than a piece of real estate. So I think it can be, the risk can be mitigated. However, I think it's always going to be more inherently risky.
Nailed it. Yep.
And if the SBA is involved and you're getting an SBA loan, their stats are 98% of those companies succeed. So, I mean, there's that 2%, you know, there's that 2%. And that's crazy that they didn't catch it. She didn't catch it. No one caught it. It's honestly, it is such
a fluke.
Yeah. I mean, it doesn't even make any sense how it all went down, but it did. And it sounds like she's going to be recouping and doing just fine here.
But it's such if people research that, like, you know, after this podcast or on their own, listen to that episode, like everything that could have went wrong. The 2% of the hundreds and thousands of businesses that are transact, and she's still just fine.
She still won.
Yeah.
SBA.
Yeah. Yep.
Yeah, it's interesting. What other items do you think, if you were doing a pro and con list, what other items would be on there? We covered cash flow, tax advantages, appreciation / forced appreciation. Which one's more risky, passive versus active, and then education, like what you need more, what requires more of a learning curve. What else would you guys say should be considered if you are doing a pro-con list?
What could have a more dramatic impact on my life over the next 5 years?
Elaborate on that.
There's no piece of real estate with a normal middle-class person could buy that would change their lifestyle, like buying the same size business as far as purchase price would. I think you can buy a business and make $50,000 a month. You can't buy a piece of real estate and make $50,000 a month.
Yeah, yeah. I mean, I would argue you're just saying cash flow in a different word. I mean, that's what you're talking about is cash flow, though.
The impact it has on lifestyle. Right?
Absolutely.
So
absolutely. I'm just saying that is kind of reiterating the point of cash flow.
But there are so many different other aspects of purchasing a business that people get fulfillment from, like the purpose. Your purpose cup doesn't get filled with real estate. Most people, like it does for a little while until you get to that 10 or 20 doors or whatever your mark is. But with a business, like you get your purpose cup filled every single day. So I think that also affects lifestyle and just quality of life.
The real estate investors that are having a huge impact, whether it be financial or purpose on local community, whatever it may be, there's nothing passive about that whatsoever. That is their job. That is what they're doing all day long. Like that's the same amount of effort as if you're doing a business. So then at that point I would just go further down the chain and I'm looking at return on capital, how fast I can go, how much control I actually have over the asset, and buying businesses is going to win on every one of those.
I would agree with that. Who should buy real estate instead of a business?
Someone that really likes their job and they're fulfilled and they're making enough money and they have extra money to park into something. Yeah. If I don't need to replace my job, I just think that more than 50% of Americans don't like their job.
I think that line, if you don't need to replace your income, I think real estate is a really, really good option for wealth building, not for.
And for a lot of people, and I'm a little bit jealous of these people, the idea of if I have 2 rental properties and I work my job and I can retire at 65 and I line those up where my debt will be paid off of and I can sail off into the sunset and be happy forever living off of $4,500 a month, whatever that number looks like to you. If that's enough, then good on you, and that would be a perfect plan.
Until you have an eviction.
Yeah, there's plenty that can go wrong. But I always thought my whole life, it's more of a curse than anything, is once I just get this, then I'll be fulfilled. And then you get that and you feel no freaking different. And then I feel like I didn't set my bar high enough. And that it feels like constantly chasing that. But for real estate, it wasn't even, closing on a house wasn't even giving me that little nick of adrenaline anymore.
Yeah. I think that's such a good point to make because, like, I always say, if you are, you have a secure job and frankly, you're bad at finances and you are, you're just trying to retire at 65, go get Dave Ramsey's book and follow it to the T. And you know what? You will probably retire at 65 and live a very happy life. You'll be fine. Everything will be fine. If you want to do bigger, the next step would be real estate. I mean, if you follow a very simple real estate investing strategy, you can retire much earlier than 65. I can almost guarantee you, regardless of where you're investing. And then the third step would be less passive, by the way, than Dave Ramsey's. Dave Ramsey's is pretty easy. Yeah. Get some envelopes. Start
saving your way out of your problems.
Exactly. And real estate, to a certain extent, is the medium between that and business ownership. And then if you want to go even less passive, we already gave passive more so to real estate. If you want to go less passive, but even quicker, business buying would be there. And I think that would be one way of looking at this, is there is nothing wrong with any of those three methods. Nobody would say you're crazy for being a Dave Ramsey fan. But if you were to say, I'm a Dave Ramsey fan and I'm going to be richer quicker than you, and I'm following a real estate buying plan and you're following a business buying plan, you'd say you're crazy. I'm sorry, that's just incorrect. I mean, and I can show you countless examples where that's incorrect. And I would say the same thing from business buying to real estate buying. It is much quicker because of the first question, cash flow. Cash flow is king, and the cash flow is just incomparable.
I want to add on to that, but you absolutely crushed that. 100% accurate.
I'll add on to it anyway.
Perfect.
I think buying a business, you can retire 10 times faster than if you were to invest in real estate. Or you can, I'm sorry, I misspoke there. You can leave a job 10 times faster than if you invest in real estate. Because retire, I mean, that's a different story.
Yeah, I
Who
completely
wants
agree.
to do that anyways?
Yeah, it all comes down to your goals, right? It all comes down to your goals. If you're a very passive person who wants to just be safe and secure and not worry about over leveraging and all that, again, go to Dave Ramsey, man. He's got that figured out. And if you want to be a little more aggressive, you should start, you should be conservative, but also start investing in real estate. And the next level is business buying.
Yeah. And I think Dave Ramsey gets such a bad rap on so many things, but I think he's so good for a majority of the country.
That's what I was going to say. I can't stand his advice. It doesn't fit for me. But for 70% of the country, his advice is probably absolutely spot on.
Yeah.
Yeah, this podcast is not for everybody.
No.
This is absolutely
It's not meant to be, right?
No, it's not. No. Business buying is sure as hell not for everybody.
I mean, entrepreneurship isn't for everyone, and that's kind of the people we're talking to. The people who have the grit and the want to get out of their situation, to change something, and ultimately have control over your future. That's the people we're talking to. We're not talking to the person who really enjoys their 9 to 5, the person who's really happy, the person who's never going to do it anyways, because it's a lot of risk. It is hard. You're going to have days when you get completely kicked in the teeth, and how do you react? I think it was Mike Tyson was like, everyone's got a plan until you get punched in the mouth.
Yep.
What happens after that? What's your attitude like? What's your demeanor? What's your action? What do you do? And I think that's it's a really good point. This podcast isn't for everyone. Business buying isn't for everyone. If you're that small set of people, the 10 to 15% who are like, I want to change, then absolutely, this is for you. Dig in, keep listening. As far as single family, multifamily, small business, what does that look like? How do they compare?
So single families right now, I mean, if you buy traditionally with a mortgage, you're not going to cash flow, right? It's going to be negative in a majority of the country, with a couple exceptions of renting out all the bedrooms.
Yes, stuff
right?
that's going to take a ton of time.
Would that house cash flow today?
If we rented it out as a single family house?
No, with 8 bedrooms, with today's interest rates. So
Yeah,
your mortgage would be about doubled.
Yeah, it would be net neutral by the time we put in all by the time we put in, because we provide utilities and internet as kind of a package deal.
So it would break even.
Yeah.
So even rent by the room right now, it's hard to cash flow. You can do it. So I don't think single families in today really has, I mean, even short-term rentals now with a massive slowdown over the past year. I mean, a lot of short-term rentals majority of people that I know are buying short-term rentals are for tax advantages now, for cost segregation, right?
Can I interrupt? Because I'm adding to this point, going back to the list of pros and cons. Also, if you were to do room rentals or Airbnb, we lose the passive win for real estate. So you're trading off on that. Yeah, absolutely. You're because it's a business. If you have an Airbnb, it's a business, dude. Mm-hmm. You got cleaners. You've got, I mean, they're not necessarily employees, but you got employees and you're replacing furniture and buying coffee and blah, blah, blah. And room rentals, I've got a couple people listening to this podcast who do room rentals, and man, they work hard.
Yeah.
They work so hard on it. So anyways, I'm sorry to interrupt, but I just want to point out that is a business. Mm-hmm. Unlike buying real estate and just putting a long-term tenant in, that's pretty passive, for the most part. But when you're doing room rentals and Airbnb, that's a freaking business, dude.
Mm-hmm. That goes back to the question you ask at every podcast: what's the best use of your time, best return on your time?
Yeah.
And if I'm running a business, making a couple grand a month doing that, am I really actually best utilizing my time?
Yeah.
Chances are.
Should I go and just do a traditional business and make a lot more money?
Yeah, good point.
And then another asset class for real estate, talking about returns, multifamily. I think right now where the majority of money's being made in multifamily is value add multifamily and hotel conversion, multifamily. They're making a lot, but that's a ton of value add, right? So you're not, obviously it's not going to be passive at all, but you can, like if you invest, say, if you were going to do it on your own, as far as you're the operator or the GP, then yes, you could make a good amount of money. However, if you're investing into, say, a syndication that is actually doing the conversions and doing the value add and all that, then you're looking at in between 10 and 20% return. I mean, that's kind of standard right now. So that doesn't really sound too good. Mobile home parks, I think mobile home parks will probably take when it comes to real estate investing for like return, because you can still, a lot of them aren't financeable through anywhere. So you're doing seller financing. So you're able to get some really good returns. But I don't see in real estate where you can get a better than a 25% return in today's day and age.
I agree. And I'm at a point I want to watch my money dance. I want to watch it work for me. So one of the biggest numbers I'm looking at is cash on cash return. How quickly can I get my cash back out of this deal and put it to work again? And there just is no comparison. You buy real estate really, really, really well, and you can get your money out in, I wouldn't even know, 10 years if you crushed it, it feels like. Like I've bought in real estate pretty well, and it takes forever to get your money back out of the deal, just your down payment back out of it. Versus businesses. I could buy business bad, and I can get all my cash back out in 1 year. Just as a general, if you want to call it a rule of thumb, but if you buy a company at a 2x multiple, and I do SBA terms, 10% down.
Say it's $1 million purchase price.
$1 million purchase price. So I put 100,000 down, which is 10%. I have 120 months, 10 years to pay it off. I'm going to be looking at a 350% cash on cash return. In under 4 months, if I take all of my profits, I can get all of my money back out of that deal.
Boom.
If I buy it at a 3x, I'm still looking at a 200% return.
And I mean, it doesn't get much better than that. Now, one question that I would push back on is, that's you guys. What if we're not you? Because we're not you. You guys are crushing it.
Bro, I dropped out of high school.
I was just saying, our combined IQ is probably double digit.
No, what do you mean though? But like, what? I guess I'm saying, what makes them so special? What do you mean? Like, what are they doing that
you guys work really hard? There's been a bunch. I mean, over the last couple of months, you guys have had a bunch of things happen, and you seem to come out smelling like roses every time. That is probably not everybody. So, what do you do that makes it different? I don't want to give anyone the wrong impression.
Yeah,
that this is easy, and that all you got to do is go throw down $100,000, and then you can, in 4 months, you'll be cash flow. Like there's a lot of stuff that happens. So,
yeah, I think that like if you're thinking about getting an SBA loan, so a lot of due diligence is done for you, right? And you're doing a lot of due diligence, so you've mitigated risk. So say we have the transition. You are a business owner, and if you did proper due diligence, your company, the company you bought, should be making, what the P&Ls have supported in the past few years. Are you going to go and have bumps and bruises along the way? Absolutely. Are you going to have a key employee quit on you 2 weeks after you bought the company? No show, no call, whatever? No, it's going to happen. But you have to roll with the punches. And I think that's where we try to channel that 10, 15% of the population. And I think that if people have that spirit and have that blood, then I think they're going to figure it out just like we figure out. There's absolutely nothing special about us. But yes, you're going to go through hard times and you have to get through it.
Yep. I think it's an attitude, and it's all we consume. I don't take in any other information at all right now. I don't watch the news. Nothing else passes through my ears, through my brain, other than private equity, business acquisition, reading books, podcasts. Like there's no way I'm not going to win, because it's all I think about and all I know at this point is what it feels like. And I think the biggest thing we have going for us is that I saw the saying a few days ago, and it's just stuck in my head, which is don't prepare, begin. And the last night before I went to bed, the CEO or the founder of NVIDIA went on and said, I started writing a business plan and I stopped and I just started. It's like the biggest hyped company in the world right now.
Dude.
And it was like made the hair on my arm stand up.
You're going to fail, but you're going to fail forward at all times. And that's what it's about.
100%. It's compounded a whole bunch of really good common sense decisions again and again, and just taking action. If you get it wrong, okay, I got it wrong. Now what do I do? How do I pivot? And it's refusing to lose, refusing to quit. If I don't quit, I can't lose.
That's don't prepare, period, begin. Correct? Is that what you said?
Maybe a comma. Don't prepare, begin.
No, don't prepare it as a sentence.
Is the end of it. And we're not saying don't do due diligence. Throw it recklessly. But so many people say, hey, this is a really good idea. I wish I could do it. And then they don't take action. And then 7 years from now,
there's 4 doors.
Yeah. And there's
getting $1,200 a month in cash flow.
A whole bunch of people that had that same piece of information and took action on it that are now multimillionaires.
Okay. So that's a good transition. So you've convinced our listeners, let's say, maybe, who knows. But so, damn, I'm just going to sell all my real estate and go buy businesses. Thoughts on that?
If you're built for that, you should run around doing that.
Yeah, so I would say it depends, just like everything. If you are trying to get out of a job and that's why you start investing in real estate and you're not where you would hope to be or where, kind of the pipe dreams that were sold to you, if you're not at that place, then yeah, I think it's something you should consider.
I hope not to jinx this because it's going to close on Monday, but my best piece of real estate I've ever bought was an 8-bedroom rent by the room, and it was bringing in just over $3,000 a month. I guess it's still bringing in just over $3,000 a month of cash flow. It's like the perfect real estate. I've actually got it. It is rent by the room, 8 bedrooms, but it's all dialed in right now. It's actually relatively passive, all things considered. And when I looked at what I could get for selling that and put it towards buying a business, it was just absolutely no comparison. And so for me now, having the confidence in seeing this work, I, with very little hesitation, came to the conclusion that it was time to sell that property and put that money, what cash flow makes the most sense, put that money to better use.
So you're talking about return on equity, correct?
Yep. I have equity sitting in this piece of real estate.
How much
so
are you
break
gonna
that down.
net?
Yeah, break that down. What
So
like?
Let's go through the whole thing real quick then. Bought the house for $800K, had to put 15% down out of pocket, so $120K into the deal. And then the loan right now when selling it is still at $645. So I think our net that we're going to hit is like
How much are you selling?
just north of $1 million.
So you're going to net.
I think our net is 370 after everything's real estate fees, all that's put into consideration.
Got it. And what was your cash flow that you were making?
So we only held on to that building for a couple of years, but with the luck of good appreciation and whatnot, we're going to be netting. We'll have 370, but our monthly cash flow was just shy of like 3,500.
That was cash flow, not gross, obviously.
That was what we were netting.
Yeah. Okay. Got it.
Yep.
So
40K a year, let's call it.
Okay, 40,000 a year, and what did you say you're making for? After all expenses on the sale?
370.
Okay, so your return on equity is almost 11%.
Yep.
Correct.
Yep.
Got it. So you're saying you're selling it because you're going to make a better return on that 300,000+.
So that 370, I could buy a $3.7 million company. From what I'm seeing out there, that should be cash flow of about $1 million.
Yeah, just shy maybe. In between 750 and 1.2.
Yeah. I think $1 million's a pretty, 900,000 is pretty safe. While I'm paying off that debt, I'm going to net about 60% of that.
So $600,000.
Yeah. Give or take $600,000.
So you're going from an 11% cash on equity to 200%.
Yep.
And that right there is
Bow,
why
bow, bow, bow.
we're sell.
And how much real estate do you just to give everyone a good idea?
Yeah, no. So I would say total portfolio owned is just north of 9 million. As far as I have a partner on all of it. So as far as what we'll make, depends because I'm okay with a fire sale.
Let's just say units, just to give everyone a good idea.
Oh,
You're
155.
You're selling 155 units to put it into buying businesses.
Yeah, 150.
So call it half of that because he has a partner, just if you're trying to be.
Yeah, so I'm trying to take, in between 600 and 800,000 out that I'm probably making, as far as equity goes, probably closer to a 20% return. But if I can take that and go buy a $4 or $5 million company, like that's why we're doing this.
Well, and I think my cherry on top to kind of give my closing point is like that 20% cash on equity and your 11% cash on equity is awesome. That's great. And if you have real estate, we're not trying to convince you to sell your real estate because those are great returns. And like I said, you are way ahead of most people if you are somebody who has real estate. But man, that should really make you think. I mean, it sure is making my wife and I think about our real estate holdings. And that was the point of this episode, is not necessarily to diss on real estate. It's definitely not. I'm a real estate agent. I kind of job security.
Same.
And, it help. I want people. You just can't touch those returns. And if back to my pro con list, if the only pro was cash flow is the most important one by far. because it feeds into everything else. It's
Yeah.
unbelievable. And we're not talking about, this one's going to make you $1,200 a month. That one's going to make you $1,000 a month. No, we're talking about 200% cash on cash return versus an 11%.
Yeah.
Yeah, I mean, we're not talking thousands, tens of thousands. We're talking hundreds of thousands of dollars of difference.
Yeah.
That's freaking
So
crazy.
just to put it into perspective, so how much did your house sell for?
$1,020,000.
Okay, so you're going to buy a company that profits around $1 million, give or take, right?
Correct.
So you're saying in 1 year's of time, you could go buy that house back.
Gross.
8 months of time.
That's crazy.
Yeah. There you go.
I have one last question. I know we got to wrap up, and it's kind of unrelated, but kind of related. Did you guys ever see the movie about the founder of McDonald's? Why am I forgetting his?
Ronald?
I was going to say that. I know it's not right,
I
but
don't.
I can't remember his name for some reason. Anyways, I think most people know one of his most famous quotes is like, "We're in the real estate business.
Yep.
We're not in the burger business." Every time we start a McDonald's, I don't think they do this anymore, but starting out, every time they started McDonald's, they had to own the real estate. Correct me if I'm wrong. All the businesses you have bought have not come with any real estate, correct?
Correct.
Is that going to change? Do you guys want to combine these two, or is it just kind of as an opportunity comes up? Like, what are your thoughts on that?
I think we're definitely open to the idea, like, because with the SBA, you can get a 25-year term.
there's
right?
real estate involved.
So,
Yeah.
So you would think, okay, there's $1 million property attached to the real estate, so the cash flow is going to just get crippled. But because it gets extended from 10 years to 25 years, that cash flow is really not affected. So, and I mean, if we're thinking about, 1031ing into something, into a business, taking real estate proceeds and doing an exchange, it becomes a lot more, I don't want to say easier. It gets more simple than trying to do real estate into business.
Got it. Sorry, it was kind of a tangent. I was wondering. It's called The Founder. It's a great movie. If you haven't seen it, it's Michael Keaton.
Wait, what's the guy's name?
Ray Kroc.
Where did McDonald?
They talk about it in the movie. It's been a long time since I've seen it. No. He bought it from. So he found a McDonald's, and but I think their name was McDonald's. Oh my gosh, I'm totally butchering this. But he bought a McDonald's, and then bought out the owners, and then like made it what it is, and then started franchising it.
Wow.
Yeah, it's a crazy story. He was a dick. Dude, anything you want to add, Andrew?
I don't think so. I think that was a good one.
That was a great
what about
episode,
you guys? Anything else you want to cap it off with?
No, I would say whatever asset class that you want to invest in, just look at your situation, because that's where it all starts, and then move forward from there.
Yep. Know yourself. Take action.
Make your own pro-con list, because cash flow might not be the most important thing for you, right?
Correct.
And if your pro-con list looks different, that's totally fine, and that is what you should do. You should not use my pro-con list, because my pro-con list was based off of what is most important to me. So determine what is your why, what is most important. Are you trying to quit your job? And then go make your decision. Don't use our metrics. Your metrics are the most important.
Love it. Well, I think that's a really great spot to wrap up. I think that a life hack in general is getting around people who make you do hard things or who are going to push you. And if you're thinking, I don't really know where to find that, go join the fellowship. Go start posting. Go start having good conversations with people like Jake, Kyle, Isaac, and I, and everyone else who's been, they've been posting. There's been deals thrown around. It's been a great place. If you want to learn, you want to figure out if you're cut out for this, and if this is going to be your path, go join the fellowship. And we would love to help you kind of figure that out. So thank you so much for listening again, everybody. We'll see you next time.